Also a warm welcome from my side. I would like to present, first of all, 2019, a little bit more on 2020. Starting off then with the orders received. And the picture at the end of the year is fairly similar to what we have seen during the last quarters. In total, we are finalizing the order intake at a level of 4,159, which organically is 4% below what we had in a very, very good year 2018. We clearly see that, especially in the segment technologies, but also partly in ENM International, that we are a bit weaker than we planned and expected and wanted. But its major driver behind that is a number of projects that time-wise will go into 2020 for order intake. And I'm also very happy to say that out of these few number but large size project, a couple of them have now been moving forward in January and February. So one of these projects that we expected in the order intake last year is a project with a German subsidiary of BP, Ruhröl. And in this case, we have now been commissioned to do engineering, procurement, and installation of pipes and pipes racks at their refinery in Gelsenkirchen. So this is size in above 100 million order intake, and that we will see in Q1. We will also hear more about Hinkley Point, where we also in Q1 now finally will have the first sizable order intake. But obviously, these orders were missing in the closing of 2019. But looking then at the weakness in technologies we will make up for in the first quarter 2020, in North America it will still require a couple of months to pick up on this. I think this is not a concern for us looking forward. Looking at the book-to-bill, we closed at 1, and looking at the order backlog, we here are closing organically 7% below the very strong level that we had when we started 2019. Then proceeding to the revenue line. As Tom said, we managed to achieve an organic growth of 6%, even above our expectation in 2019, the second year in a row with this organic growth. We managed to take the EBITDA adjusted up to the level of 104 million from 65 in previous year. And we also had a similar number for the adjustments, 72 million in 2018, also 72 million in 2019, but brought the reported EBITDA to 32 million in 2019. In the 72 million of adjustments, the two major positions being the IT rollout, our system harmonization that we have been working on for a number of years, and we will finalize in Q1 2021. So we will also see a number here, and we'll show it later in the presentation, for adjustments on the system harmonization coming through in our guidance for 2020. And then a very small number in the first quarter of 2021. In addition to that, 40 million of restructuring expense. And after our announcement after Q3, we obviously were increasing this number, so we now have also covered for the Sub-7, the latest restructuring program that we have initiated in last year. So all the cost for driving this SGNA program further down has been covered with provisions in 2019. Obviously, the cash out would, to a large extent, only follow in 2020. So 40 million is that, and a bit more than 30 million coming from system harmonization. Then looking at the two main drivers for the improvement that we have achieved, but also above all the improvements that we intend to achieve in 2020 and 2021 to bring Bilfinger up to the sustainable EBITDA, and I say deliberately EBITDA, not adjusted, not reported, one EBITDA of 5% in 2021. The first one being the gross margin. And I like to be transparent because I know that you see everything that we see. Looking at the gross margin developments over the last years, we achieved an improvement in the last quarter. So we closed the last quarter with 11.3%, a significant improvement versus the last quarter in 2018. But looking at the full year, we are only at 9.5%, so a small improvement versus 2018, which was 9.4%. In this area, we see most of the improvement that needs to take place, and we also will hear, especially from Duncan later on, what we are going to do to bring this 9.5% in the next coming 2 years up to the level of 12%. You will also see later on that a big part of our business today is already at 12%. We just need to make sure that the remaining part of the business will improve to also make sure that we in total get to the 12%. So operating margin or gross margin improvement visible in quarter 4, but a big step up required here in the next coming 2 years. The second most important lever is then the SGNA ratio. Here we have over the last years proven that we are able to reduce this. We have closed 2019 with a ratio of 8% versus the year before, 8.7%, starting off with above 10% in 2016. So year by year, a clear improvement and a good track record. And we will continue this journey with the restructuring program announced in autumn last year. We will bring this ratio now with a flat top line down to 7.5% in 2020, and then down to 7% in 2021. And then trying to target, even if we start to grow again, to stay below the 7%. So these two, SGNA ratio and the operating margin, being the most important steps forward to make sure that we move on this journey from 2.4% to hopefully above 5%. Looking at the 3 segments that we are reporting externally. First of all, the largest segment, which is engineering and maintenance, ENM Europe. Another year of a very sound performance throughout the year. This part also making sure that we, during this year of 2019, were able to make up for the downside that is visible in technologies. So ENM Europe bringing more to the table than we originally expected to make sure that we are keeping the promise for the whole group. Looking at orders received, slightly below, organically a decrease for the year of 5%. However, we have here also the effect that I mentioned, Hinkley Point, but also the BP project in Gelsenkirchen, that partly will bring a benefit to technologies, but also ENM Europe units being involved. So with the strong order intake in quarter 1, we are not concerned about the workload in ENM Europe for 2020. Book-to-bill, still closing at 1. Revenue, an organic increase in 2019 of 2 to 3%. And EBITDA adjusted closed at 101 million, which is in line with previous year, a 3.7% margin on EBITDA adjusted. So solid performance, continuous improvement, but we still see potential here for further growth, but also for further profit improvement. So for 2020, our guidance for ENM Europe is a fairly stable revenue development, but a significant positive development of EBITDA adjusted. And that is, of course, a stronger focus on continuous improvement, but it's also the mix. We have a large number of what we call in Bilfinger turnarounds, larger revisions in the maintenance business. These are normally generating a very solid and good profitability, and we have increasingly for the next coming 2 years more and more turnarounds that also will pay back in the segment of ENM Europe. I also would like to mention that leaving 2019, going into 2020, we have 4 legal entities in ENM Europe that we have strategically decided that they don't fit in our portfolio, and they will be transferred into the segment OOP from January 2020. That represents a sales of approximately 200 million and an EBITDA adjusted of around 5 million. The performance, though, the 5 million, that low in 2019, was hit with some one-time costs. So 4 legal entities moving on and having an impact of 200 million sales less in 2020. Moving on to the second part of ENM International, where North America is the larger part of this. In this part, we were extremely happy with the developments. We had strong organic growth in sales, revenue organically increasing with 15% thanks to US and some very successful projects. We managed to get to an EBITDA adjusted of 42 million, so 10 million more than in previous year, a ratio of 4.6%. So a very, very strong performance, especially in North America in 2019. And looking into 2020, given what I mentioned in regard of the order books, that North America, especially when it comes to the project business, has got some time delay here before the next larger project started. We are expecting that the top line that was achieved in 2019 will not be possible. So we will have a slight decrease in revenue due to the order book situation in North America. But we expect, nonetheless, an improvement in regard of the EBITDA further, especially coming from the Middle East, continuous improvement, but also a more favorable portfolio. Last but not least, our problem child, technologies, that we already after Q1 last year had quite in detail to explain what is happening. Segment technologies with 5 legal entities have in 2019 had a difficult journey. 3 entities not generating poor performance. I stress that 3 entities were profitable and meeting the expectations for the year of 2019, even if we expect more growth and more profitability also from these 3 entities. But 2 legal entities being in focus, one hurting us badly in the first half, and in the second half, the second entity. This has been a difficult journey in technologies, and I confess that we, after Q3, jointly still expected that the final result in technologies would still be at least better than in 2018, where we had a loss of 26 million. But some happenings on some of the projects, and also the need to take some additional provisions here, to be cautious, we were forced to say minus 28 million is the result of technologies in 2019, so not satisfactory at all. I think it is important to isolate these 2 entities, and I know that Duncan will also speak a bit more about what additional actions we have taken now to make sure that this story will not repeat in 2020. The first one, we started to stabilize in Q3 and 4, and actually had losses in Q3 and 4, but very small losses. The whole segment of technology was, however, profitable in the last quarter of 2019, but it was less profitable than we had forecasted due to 1 legal entity and a couple of projects. Now looking into 2020, and with this track record, it's difficult, I think, to convince you that a problem that we have now had for a number of years, we are really going to be able to turn around in 2020. We are expecting, not the least, also thanks to a very good order intake in January, a significant increase in revenue here, and a positive result for EBITDA adjusted. And that goes back to turning these two legal entities around and making sure that we at least get them to break even in 2020. But we're coming back more to some insight on the reasons behind it and also additional actions that we have taken. Strong cash generation, especially in the last quarter, as Tom mentioned. Between September and December, we reduced the DSO with 10 days. So very, very strong movement forward here. A pity that that movement is not coming during the year. We have a track record here of being very, very strong also in the cash generation in the last quarter. What are we doing about that? We are actually changing our incentive system for 2020 so that we stop measuring cash flow only by the end of the year, and we will now measure it quarter by quarter to also make sure that we have the maximum effort earlier during the year to drive the cash flow. Looking at the adjusted operating cash flow here, we are achieving a clear improvement for the year, 181 versus 110 in previous year. A strong positive step forward. However, it doesn't mean that we are happy with the cash generation. Also during the next coming years, we need here to make sure that we are moving forward and reducing the working capital, improving the EBITDA to support the cash, but also making sure that these adjustments are not happening anymore, that we don't need further restructuring, that we don't need any kind of adjustments, because that's also having an extreme impact on the cash flow generated. You see the net trade asset. I don't need to talk about that. On the net profit side, you see the net profit, the swing from -24 in 18 to +24 in 19, and the adjusted net profit moving up from 36 to 49. So also here, a very strong performance in the last quarter. Not good enough. We will continue to drive this topic. Last but not least, the outlook for 2020, confirming what also Tom said before and we already announced after quarter 3. We are expecting on the basis of our existing backlog and top line that is flat, so organically stable. We are expecting that the EBITDA adjusted will move up to around 4% in 2020, so a big step up from 2.4%. And in regard of the free cash flow reported, our guidance is a significantly positive development. With that, I would like to pass on to Tom again.
Okay, thank you.